Facebook is down dramatically from its highs. Paul, should I be buying or selling this stock?
Facebook has fallen a ton, right? So the question becomes, is it a market overreaction or is it fundamentally different now than it was at $380 a share? So let's pull it up in our software. We're going to go to Facebook right here, which is also Meta companies, Meta platforms. Let's go through the 8 pillars real quick. As you can see, first off in this chart, huge drop.
I remember that day like it was yesterday, Paul.
In the last 52 weeks, though, the high was 384. So Facebook is now a $600 billion company. It was over $1 trillion at one point. The first pillar, we want the 5-year PE below 22.5. It's 23.78. That's an X. So you might sit there and say, oh, it's too expensive. Hang on a second. Let's remember that if a company is going to grow 100% a year, hypothetically, at this value, would you buy it? Absolutely, you would. Now, Facebook's not going to grow 100% per year, but you'll see my point soon. Pillar number 2, what is their 5-year return on invested capital? How well do they reinvest their capital? We want it to be over 9%. It's 15.5. Pillar number 3, let's go to their revenue growth over the last 5 years. This dead company that has no user growth, 26.89 to $118 billion in revenue. That's huge growth. Pillar number 4, we want the net income growth to be growing over the last 5 years. 15.93 to basically $14 billion. Is that good? Answer is yes, it is.
Paul, I read an article that said, we were saying that the usership is growing and they make almost, $40 a person here in America?
The revenue per person worldwide, I think, is $40 per user.
Worldwide, okay.
But they're not growing their per user growth. And that's what gets people scared. That's why they fell.
People are also saying over in other countries, more remote places, they're not going to get that type of return off of each individual.
They won't, but they still haven't maximized their revenue per user here in the States yet either.
I see. Gotcha. Okay.
So, pillar number 5, guys, we want the company to be buying back shares. We want to see shares outstanding decreasing. So I go to the 6th year before, gets the end of the year. They had 2.86 billion shares. Now they have 2.82. That is a check mark. So they are buying back shares. Pillar number 6, we want to look at their 5-year free cash flow and compare it to debt. So I go back to the main page. Their 5-year average free cash flow is 23.4. I multiply this by 5. That equals 107, let's call it $115 billion. We want their total long-term liabilities under $115 billion. So we go to the balance sheet and we scroll to the very bottom. Long-term liabilities, $20 billion.
I know when you smile like that, you have that smirk on your face.
It's ridiculous.
Incredible.
Seth, you want to see something even better? Their total cash on hand is $67 billion, and their total liabilities are $41 billion. They can write a check for all of their debts, pay it all off, and still have $26 billion left over. That's 5% of their market cap.
My God,
eliminated.
Bonkers.
It's crazy. This company ain't going under. Does that mean there's no headwinds? Of course there's headwinds. It's social media. It's everybody's anti-Facebook, blah, 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 blah. But how much of it's perception? That's the question.
Okay, Paul, before we get to free cash, let me remind you, we will move toward what you should be paying for Facebook moving forward using our stock analyzer tool. So stay tuned for the rest of the video. Go ahead, Paul. Free cash.
So free cash flow is the lifeblood of the business. As you guys know, it's cash from operations less your capital expenditures. Cash flow statement, here it is right here, added by us in this line. $17.5 billion to $39 billion in free cash. That's insane. And our final metric, we want to compare the market cap of the business to the free cash flow it generates. We take the 5-year average free cash flow, 23.3 multiplied by 20, and that's $466 billion. The company was 500 and some, right?
600 billion.
600 billion. So that's an X. So guys, we had 2 X's on this. Let's go to our 8 pillars tab.
This tab is incredible if you're watching at home because you don't have to do any of that math we just did. We give it right to you. Go ahead, Paul.
So this is saying, oh my God, it's expensive. We've done 1,000 videos. We're like, it's just expensive. But guys, I actually don't think so. And the reason being is I think they can grow their revenue at a much higher pace. So that's when we bring in the stock analyzer tool. So this stock analyzer tool, what it does is it allows us to sit here and put in our assumptions about the future, first of which is growth, and determine if the stock is reasonable to buy today. So I'm going to look at a 10-year analysis like I always do, because Facebook, even though everybody's starting to dislike going on Facebook, they still have Instagram, they still have WhatsApp, they still have Oculus, they're building the metaverse. This company's going to be around for a while. Now, what are my assumptions? Here are 10-year numbers. I'm going to go conservative. Let's go 8% revenue growth, 12%, and 16% revenue growth. Profit margin. I'm going to go 31, 32.5, and 34%. Free cash flow. Oh, I'm sorry. I did 31, 32.5, and 34% because their free cash flow and their profit margin's about the same.
Mm-hmm.
PE. I'm going to go 13, 16, and 19.
That high, huh?
So here's the reason why.
You can overpay for a growing company?
Yes. I believe that the growth potential in the future is much higher for Facebook, and people are not recognizing that.
Mm-hmm.
Same with the free cash flow, 13, 16, 19. And guys, like usual, I want 12.5% return on my money because if I buy a regular ETF, I'll get 9 or 10%. So for margin of safety, give me this. The analyze button's been hit. The company's currently at 214.
Mm-hmm.
All greens, guys.
Green.
217 is my low. $538 is my high. What this means, guys, is if all these high assumptions come true, I should be paying $538 today for the stock to get a 12.5% return. And the middle number is 342. Now, guys, with our software, I can sit here and add a plus mark, add to my watch list when it hits below 342.
I love this. I don't got time to track all these stocks, but the watch list is
And by the
awesome.
way, I got a message yesterday in our community. Somebody said, Paul, this watch list is incredible. I've already gotten several notifications on stocks I wanted to buy at the price I wanted to buy them at. Wonderful. So, spoiler alert, I own Facebook. And I'm not telling you to go buy Facebook. I'm telling you to learn our process because there are 10,000 companies out there. And for those of you who are already part of the community, which is a lot of you out there watching this video, you've learned the process. Go enhance yourself in the process. It'll pay dividends down the road because I'm here to teach you the process. You guys want to be taught something. We are here teaching it to you. But we're also providing feedback in individual companies at some point.
Check out this video before you go, and we'll see you in the next one.